Hi, I'm Diane Polini, the Community Manager of Leading Peers. Welcome to another Leading Peers Masterclass. In our Masterclass series, Leading Peers provides open and free access to education from experts to help CEOs succeed. Today, we'll learn from Leading Peers member Matt Dernis. Matt is also on the board that advises our CEO, Leo Popick. Matt is a certified financial planner and a certified plan fiduciary advisor with 2 decades of experience in personal and business financial planning. This masterclass is called The Importance of Profit Distribution. Matt, take it away.
Well, thank you, Diane. So today we're going to talk a little bit about the decision that small business owners make to reinvest in their business or to take a distribution as net income and invest in their personal wealth accumulation strategy. Throughout this presentation, I may use terms that may be unfamiliar to some and familiar to others. But please excuse me if I talk about something that you already know, and we will hopefully make this interesting for everybody. So for many small business owners, when they first start a business, they have success. For many, the decision is to reinvest in the business because they want to see the business grow as much as possible. And the idea is that if the return on that net income is greater by reinvesting in the business, let's see how far we can take this, right? But for others, the decision might be to take distributions and use that money, of course, to cover personal expenses. But and for many, it's to build their net worth, to grow their savings. So today we're going to talk a little bit about how you might balance that decision, how you might measure the amount of money you might want to reinvest in the business on an annual basis versus how much you might want to take out, not for just your living expenses, but for that personal wealth accumulation strategy that you have in mind. And what are some of the benefits that taking that money out as a distribution and building your net worth, how that might actually benefit your business. So that's what we're going to talk about today. And first, let's look at some of the questions that you might think of when making this decision each year. So the first question is, what are your financial goals? Are you in hyper growth mode with your business, or are you looking for a measured and sustainable growth that can provide for shorter term personal income needs? Another question you might ask is, what are the business's current financial needs and goals? If you commit capital to increase your capacity by hiring before you have the demand, how much liquidity will you be left with in the business, and how would you compare that with financing? Assessing your short-term and long-term financial requirements, such as covering operating expenses, paying off debt, or funding expansion, are things that you want to evaluate. You want to try to calculate, how is that going to play out for you if you reinvest that capital? Some other things that you might want to look at is, and by the way, when you're thinking about the financing part, the reinvestment, take into account that you might have some, if you have outstanding loans, debts, or financial commitments that may require you to allocate funds for repayment. Maybe the money you're reinvesting isn't fully going to growth, so you want to think about that. And then another question that you want to ask is, how stable and predictable is your cash flow? This is an important question, right? Because when you reinvest that capital, for some businesses, there's a low conversion ratio with business reinvestment, but there's a high rate of return on capital. So how is that cash flow going to look like when you reinvest it? Are you going to have to figure out, the reliability of the revenue stream that you're receiving and whether you can consistently generate enough income to cover your expenses and grow the business at the same time. Are you hiring, are you going to have to hire another person? Are you going to have to, and how long is it going to take to train that person or multiple people? And then you also want to stay informed about your business, about your industry, industry trends and competition. What are they doing? Reinvesting to stay competitive or adapt for changing market conditions may be necessary. Reinvesting capital. How likely, again, the reliability question, how predictable, if you reinvest that capital, how likely are you going to see a return? I know these questions are things that you think about every day. I know I'm not telling you something you don't know. I'm posing the question so that when you think about the answer, you're comparing that with the net income that you've reinvested into the business versus how you might take that cash out and invest it for a personal wealth growth, personal wealth building, and investment in something else, which we'll get to. Now that you are confident in the potential outcome for reinvesting in your business, another question is, how much risk do you want to take with your reinvestment? What I mean by that is, do you want to pursue rapid growth, or are you a business that no matter what you do, or no matter how much risk you take, you're more likely to want or need stable growth? Is that does your industry, is it better suited for a stable, slower growth rate that's consistent and reliable? Is that a better fit for your business model? So if you have multiple owners in your business, sometimes taking profit can build loyalty and give a feeling of stability as well. That's another thing to consider. So now we're gonna look at how you calculate a target growth rate for your business. I know for many people, they know, hey, I grow at 10%, 15%, 20% per year. Or maybe, like I said, you're targeting a 50% growth rate. So you might have some targets in mind. You might have or you might even know what your rate of return generally is, or maybe it's not clear at all. Maybe there's so much variability. There's you're up and down and changing, which, by the way, you have to think about, like, how does that impact your decision now to take those profits and reinvest it back into a business if your rate of return or your growth rate are up and down. So we'll look at that. So here's one way that you might calculate a return on your investment. So start with your total revenue, subtract your total costs, and then you divide that by your investment cost. Multiply times 100, and that's your rate of return. So before we're finished with this section of, whoops, oh, we could put a happy face here. So while we're still on this section of calculating the rate of return on your reinvestment into the business, many business owners may not fully consider how important it can be to distribute that net income and reinvest in their personal wealth accumulation goal. So aside from getting lucky in choosing a high-performing investment, I'm sure we can all agree that the best investment results will come from a well-thought-out plan. We're talking about taking a distribution and investing that money. So being mindful of how much you reinvest versus how much to distribute can be very important. Just as there are many factors to consider when reinvesting in your business, there are factors to consider in your personal wealth accumulation strategy, so that when we compare those rates of return, we feel confident that it's the right choice. So each of these factors that I will mention can have a significant impact on the rate of return. So first, you got to decide on time horizon, liquidity needs, asset allocation, risk profile. All these factors are interconnected and play a crucial role in shaping an effective investment strategy, and ultimately the rate of return on that money that you've taken out of the business as a net income, as a distribution, and invested it into this, personal wealth accumulation. And we're comparing that versus reinvesting into the business. What's going to make you more money in the end? What's going to create more, value, and what's going to give you, more success in the future between your business and your personal savings. So these are factors that I think are you should, definitely consider. An investment strategy. First, before I go any further, the optimal strategies vary for each individual or institution based on the unique circumstances, financial goals, risk tolerance. Regularly you should reassess and adjust your investment strategy to align with changes in the factors that we mentioned, and it's essential for long-term financial success. So let's first talk about let's talk about time horizon. The time horizon refers to the duration for which an investor plans to hold their investments. A longer time horizon generally allows for a more aggressive investment strategy, as there's more time to recover from a short-term market fluctuation or an investment fluctuation. The other thing you want to think about, which we mentioned here, was liquidity needs. Liquidity needs refer to the investor's requirement for easily accessible funds. If an investor has an immediate cash need, for instance, you have to put money back into the business, or there's a personal need that you didn't plan for, if you want to think about that in advance, because this could you want to minimize the risk that you can take, and that could cause your target rate of return to be lower. So if you're thinking about, if you have a short-term liquidity need, how do you compare, do you even use that pot of money that as part of your longer-term wealth accumulation strategy? And should that even be part of the equation when comparing taking that income versus investing in the personal wealth strategy? I would argue you only want to think about those funds that you're taking out of the business for the long-term strategy if you're comparing rates of return, not your shorter-term investments. So you also want to think about your risk profile. That's another factor that we mentioned. Risk profile assesses an investor's tolerance for risk. That's what I'm referring to. It influences the mix of investments that you're choosing. And so with riskier assets, will potentially provide higher returns, but it will also provide higher volatility, which is why you're going to think about only the longer term money, that the money that comes out of the business that's set aside for long-term investments. Therefore, you can consider higher risk, higher volatility potentially. Of course, you also have to think about the behavior involved, which we're going to talk about that, meaning how comfortable are you? So a risk-averse investor may lean towards safer investments like government bonds, while a risk-tolerant investor may be more comfortable with higher allocation to stocks, equities, which can be more volatile, but has the potential to offer a greater return. So now let's talk about what investment strategies could you consider. So again, we're trying to get to what's that rate of return that we might want to be targeting to compare versus that reinvesting back into the business. So on the so we're going to talk about asset allocation. Asset allocation involves distributing investments among different asset classes such as stocks, bonds, and cash. And the right mix, may play a large role in the rate of return you receive, as well as the potential for loss, by the way. So the question is, how much stocks or stock mutual funds do you want to have in your portfolio versus bonds or bond mutual funds? And this will play a role in how your investments react to economic events. For example, interest rate movements or energy prices, rising or falling. Other than closing your eyes, other than closing your eyes, waiting 10 years to see how your investments perform, it's just hard to escape the emotional perspective that you will have on your investments. So understanding your expectations may be worth exploring when it comes to impacting this decision about how you invest that money. A conservative investor approaching retirement might have a larger allocation of bonds because they're thinking about how they're going to need income when they get to that target date, while a more aggressive investor with a longer term horizon might have a higher allocation to stocks for potential growth. Again, I'll keep talking about how more weighted in stocks are going to give you that longer term return, that longer term horizon, that higher rate of risk, potential volatility. Okay, so we're going to delve just a little bit deeper here. We're almost at the end of this analysis, but a little bit deeper from asset allocation, which I'm going to imagine that for many of you, you're familiar with this, but we're going to talk a little bit about two different allocation strategies. So management style is important, right? Meaning, are you using an active approach towards picking these stocks, bonds, mutual funds, however you're investing the holdings that you can have in your portfolio, or using passive? In an active strategy, there's a fund manager or an individual, or you're the individual investor actively making decisions to buy and sell securities with the goal of outperforming the market or a specific benchmark or index. The premise here, though, is that research, analysis, market timing, active managers can identify undervalued assets or they can time market movements to achieve a better result than the overall market. So the question is that from a decision standpoint, is that something that you can rely on? You may also adjust your allocation in an active strategy based on economic conditions, market trends. Now, the cost of this is important. The cost of active management is going to be a little bit higher than in a passive strategy. So, will the results from an active strategy outperform that of a passive strategy? So, passive, I think, sort of makes sense from the word passive, but the goal is to replicate the performance of the index rather than trying to outperform it. Passive investors believe in what they call the efficient market hypothesis, which suggests that markets are generally efficient, and it's challenging to consistently outsmart the collective wisdom of the market and participants. Passive investors often use what they call index funds or exchange traded funds. So some of you may have heard of those, but that's might be the way that you could achieve a passive strategy. Now, the philosophy here, or the key difference, is that active investing relies on the belief that superior market insights and active management can lead to better returns, and passive investing follows the belief that markets are efficient, which I mentioned here. The costs, of course, in a passive strategy are going to be lower, thereby potentially giving you higher returns. If in fact, the active manager hasn't, substantially gotten it right every time. Turnover in a passive strategy is going to be lower, so it might impact taxes. Active strategies, again, if you're buying and selling and you're having success, you have to figure that there's going to be some capital gains, which means there's going to be some tax due. So again, having a proper way to manage to calculate that's important. So ultimately, the choice between active and passive investing depends on individual preferences, beliefs, individual goals. Some investors may choose a combination of both. And so here's a way in which you could do that. There's two ideas. One, you can use what's called the core portfolio. The core portfolio is where it's designed to be a more stable and conservative approach, often composed of a broad market index like the total stock market index, or the S&P 500. Some might say that you could use that as a core. These investments provide diversification across various asset classes, such as stocks, and sometimes they may even include some bonds in there, depending upon what type of fund you've used or what type of investment strategy you've used to create your core, right? Whoops. I jumped ahead here on my slide. Sorry about that. And I wasn't on the screen that I needed to be on. But here we are. Now we've caught up on the screen. All right. So I was talking about core portfolio. Now, the way that you can deploy the active and passive together in one approach, one nice, neat approach might be what they call the core satellite. So the way that you could probably illustrate this in your mind: core, the center, and satellite being you're choosing some individual sectors, maybe something that's specialized or focused on a specific sector or a theme. Something like, maybe, you could even just say, I'm going to overweight in a small cap index or a small international index or emerging markets, or maybe you want to own a tech fund or a technology fund or a tech dividend fund. These could be satellites that you could overweight in and just rotate based on an economic philosophy that you might have. So the rationale behind core satellite approach is to combine the benefits of stable, diversified core portfolio with potential of outperformance or specific risk exposure, offered by those satellite investments. The strategy allows investors to have a well-balanced, diversified foundation, and has some flexibility to it. So if your goal is long-term wealth accumulation and the best time to invest, if you're thinking about timing, the best time to invest is typically as soon as possible. I say that because timing the market, as we talked about before, could have a significant impact on whether or not you outperform or underperform. Historically, though, the stock market and many other asset classes have shown a tendency to increase value over the long term. So starting early allows your investments more time to grow and compound. Historically, stocks provide better returns than bonds, while bonds are generally less volatile. For example, from 2010 to December of 2023, just recently, the S&P 500 has averaged approximately 10% in those 13 years. And I would also tell you that if you look back in time historically, if you give yourself more than 10 years, you're going to see that there have been some years where things look flat, but when you go beyond the 10-year mark, you generally see a very successful rate of return. For the same period, by the way, that same 13 years, the U.S. aggregate bond index averaged 2.19%. And I have to say, though, that whether or not that's going to happen looking forward, I don't have that crystal ball. But the interesting thing is that interest rates went down for most of that time, right? So interest rates have a significant impact on that. So if you are close to retirement years and experiencing by the way, about market timing, let's talk about that for 1 second. If you're close to retirement years, experiencing a market drop in the early years of your retirement can create problems that can go way beyond the immediate hit to the portfolio, potentially to the point where you could permanently lose years worth of income. This is, and by the way, this is called the sequence of return risk that could, have a catastrophic impact. And so what I would, again, going back to what I mentioned earlier about making sure that you're focused on long-term investment strategies for the money that you're taking from the business, that's the objective. That's not to say you shouldn't take money out of your business for short-term needs. I'm saying if you're weighing whether to reinvest it into the business versus what else to do with it, that would be the other alternative, a great alternative. So to address, and by the way, to address the short-term needs, many of you are familiar with, maintaining reserve funds for low risk liquid investments that you can use to cover your expenses while you avoid tapping into your stocks. So make sure you have that reserve fund if you're going to put this long-term strategy in place. And so ultimately, the decision to take profit or reinvest should align with your business specific circumstances and goals and risk tolerance. First, you may want to speak with your financial professional, like a financial advisor, certified financial planner, you should probably speak with your CPA, because there may be some tax impact here, and there may be some tax advantages or some tax pitfalls. You want to make sure you avoid those. So when you're making this decision in the end, you want to strike a balance between taking some profit and reinvesting. You can strike you don't have to choose between taking all profit or reinvesting everything. You can, balance between the personal wealth accumulation and taking profit. And in fact, I would recommend you choose. There's an approach that I would recommend. I believe that an optimal strategy may be to pick a percentage that seems reasonable, and not worry about the perfect balance. Adjust it and then adjust it as you move along. I'll give you an example. A percentage, a good minimum percentage that you might start with is taking 10% of that net profit that you have in your business, and set that aside and put that towards your long-term investment strategy. Now, for some of you, that 10% may be too small. Maybe you have enough other savings or enough other your net profit is significant enough that you could choose a larger percentage. But I would start with that 10% at minimum and go from there. 10% of your net profit. So a percentage of that net profit will get reinvested into the business as well. 10% to that long-term investment strategy, 10% to reinvest into the business, and the other, maybe that's money that you need to take out, to supplement the salary that you're taking every year. So with this approach, I think you're going to have a well-balanced strategy for growing your business, a well-balanced strategy for building your net worth, accumulating growth, creating a more stable, cash and asset position for yourself and your business, making it much easier from year to year to make some riskier decisions. If you're starting, behind the eight ball, as opposed to, being way ahead with that security, it makes it a lot easier to make great decisions in the business and not worry about risk nearly as much. So with that, I hope this masterclass was interesting to you. I hope maybe it brought some ideas to mind, gave you a few tools that you can put in your bag, or may already have, and just decide, I think I'm going to bring that out and put that to work. And thank you again, and hope this was helpful, and have a great day.
It was. Thank you. And show us the last screen because it has your contact information there.
Yes, there we go.
Thank you, Matt, for a great Leading Peers Masterclass. We ask that you all remember to subscribe to our YouTube channel, where you can see our incredible and informative content like what Matt just shared. Leading Peers is a community for CEOs to connect, collaborate, and grow. If you're a CEO, visit us at leadingpeers.com to learn more about how to join us. Thank you and have a great day.